Are the big banks or institutions hunting out your stop loss? Loss. A question I've often asked myself in my 33 years of trading. A question I've often been asked. Hey, for those of you who don't know me, I'm Rob. And for those of you who do know me, I am still Rob. It's Coffee with Rob. Let's have some coffee and let's discuss this topic. What's the short answer? What's the short answer to are the big banks hunting out your stop loss? It's a bit of a tricky answer because it's a bit of a yes and a bit of a no. There's two answers to this question, which is what makes it a huge topic of discussion. The thing to remember here is retail traders are in a slightly different space to the pros. The pros have got an insane amount of information way before you have. And they also don't only trade on charts. They don't only look at the charts and go, oh, I'll take that trade and we'll see what happens. In fact, the pros don't even use a stop loss. So that kind of brings in a new sort of formula as to what are these guys doing? Well, they're creating liquidity and they're looking for liquidity. So are they hunting out your stop loss? Well, the kind of direct answer to that is no, they're not searching for your stop loss. What they're looking for, if you consider it logically, is all the orders in the market. Now, here's the thing, guys. Retail traders like you and me trade with charts. We use a system, we use a high probability system to trade with. And what we do is we position our trade. And when we position that trade, we have a strategy. And the strategy is what makes us the money. I'll discuss the strategy at the end of the video. What we do is we end up placing our stop loss in place so that we can walk away and leave the trade on its own. You and I both know how this works. You've left your stop loss there. So what you've done effectively is advertised where your order is. You've told everybody that's where my order is. If you're looking to come and get my order, just drop down and have a look, and it's flashing red lights. Here I am. If you want me, come and get me. This is why I always say to you guys, when you put your stop loss in place, when you take your trade, when you look at your trade, look for an area of invalidation where you know if the trade got to that level, it would be worthless to you. It's not going to work. And look at putting your stop loss in that area, which is a little bit away from the areas where these guys might be looking for money, might be looking for liquidity. Because the long answer is, yes, they are looking for liquidity, and that'll be an area where there's a lot of money waiting, where there's a lot of people waiting to take a trade, whether it be a stop loss or whether it be a buy. That's what they're hunting out, guys. Are they looking for your stop loss specifically? You're not that important. Sorry, I didn't mean to put it that way, but you're just not. Neither am I. We don't have that kind of money. We don't have that kind of ability to make much of a difference to the pros. But combined, we do. So if we put a whole load of liquidity in an area and we all do it in the same area, then they're going to come down and they're going to pick that off because they need that money to take their trades, or they need those shares, or they need those lots, or whatever it might be, so that they can take their gigantic gargantuan trade. The reason they don't leave an auto stop loss in place is simply because the amount that they trade would be too big to leave an auto, because when it gets to that, it's just going to keep on going lower and lower and lower and take too much away. They really need the liquidity to get out of those trades, where your trade would get taken instantly. I don't care how much money you think you've got. In the greater scheme of things, You're just not that important. So when you think they're hunting out your stop losses, change your mindset and think to yourself, well, wait a minute. If I think they're hunting out my stop losses, that means they're getting my stop losses. So what do I need to do to change that? What do I need to do to make, well, there's two ways. There's two ways. And I know I didn't finish that sentence. But there's two ways you can do this. The one way is not to put an automated stop loss. What do you think of that? In other words, handle your stop loss up here. Then they don't know where your stop loss is. Big issue with that is the following. In most cases that I've seen, the trader doesn't take the stop loss. In most cases that I've seen, you'll have to sit there and watch your charts, because if you go out to lunch and have a bit of fun, when you come back and you see that long red line going down to zero, that could be a bit tricky for you. So if you don't put the auto stop loss in, or if you don't put the actual order in, then you don't really know what's going to happen if you're not there. And if it does happen, it's going to be a bit of a shock to you. But yes, you could hide your stop loss from everyone because no one will know where it is in your head. That works. That's one way to do it. But the other way to do it is just like we do it in the strategy, is to have a look at the trade and just say, well, if my stop losses get taken out every time, it's not because they're hunting my stop loss. It's because my stop loss area is just too close to the cost, and it's in an easy area for them to pick off. What I need to do is put it a little bit further away or a little further out. Why do I need to put it further out? You probably find that you're putting your stop losses in an area that's not invalid, in an area where if the price gets back to that stop loss, in all likelihood, the trade is still valid. It could still work. And that's why you're getting your top stop losses taken out. You need to put the stop loss in an area where you know the trade's invalid. In other words, further down, probably below the lows, probably below the supports, above the resistances, but enough distance away to understand, in all likelihood, no one's going to want to search that stop loss out because it's gone into a different kind of trade. In other words, if it got to that area, then the trade wouldn't be valid to go up again. If it was a short, a long, then it would be more like it had turned into a short, and it would be a different kind of order. Keep that in mind. There's two ways to do it. One is to take the stop loss away completely. The second one is to relook where you put your stop loss, because that's clearly affecting your trade. And that is part of the strategy, because you want to keep your stop loss the same on every single trade. So all you've got to do is when you look at your trade and you decide, well, that's a good area to put my stop loss, I'll put my stop loss there. Then you can just work out how much it is back to your cost. Let's say your stop loss is $250 on every single trade. Then all you've got to do is work out how many lots is $250 back up to the cost, how many pips, whatever you're trading. How much is that? How big is my trade? And then from there, it's easy. Then all you have to do is work out your risk to reward. Is it good? Is it bad? Will this trade work? Will I make more money on my wins than my losses? Because that's the strategy, guys, by the way. The strategy is to win more on your wins and lose less on your losses. That sounds simple. But the trick is to have a business plan. Because I don't know anyone who would actually start a real business without some kind of a plan. It doesn't have to be an insane plan, but you do need to have a plan. You need to know, firstly, what kind of business you're opening, where it's going to be. Do I need a factory? Do I need stock? You know, all these different kinds of things that you kind of going to need to know if you start a business, that for some other odd reason, when you start trading, you don't seem to concern yourself too much with that. You just start trading and you don't even care if you've got a business plan or not. So the strategy is simple and the business plan is simple. And that is, for me, what I do is I risk 1% on every single trade. 1%. That's mine. You can risk 5%. You can risk 0.25%. Doesn't matter. What I always say is risk what you feel comfortable with, what you feel you can position in a trade, and you can walk away, go shopping, go to the beach, enjoy yourself, have lunch, come back, have a look at the charts and say, oh, everything's still fine. It's okay. Go to sleep at night, not worried if you lose the money, because you've got to understand that you're going to lose half the trades. And when I say trading's 50-50, It really tires me out when people argue with me on this point and they haven't watched the whole video and they don't understand that the system's not what makes you money. The strategy is what makes you money. And then they say, oh, the market can't be 50-50 because there's a high probability trade and some of them are going to win and it's got to be more than... It must be. Just watch the video, listen to the strategy, and forget about the squiggly lines in the system. And then you'll have that aha moment and you'll be like, oh, that's how you make money. Just saying. Anyway, great stuff. The strategy is simple, like I say. I've chosen 1%, and let's say that's $250 on a $25,000 account, $1,000 on a $100,000 account, $500 on a $50,000 account. Let's use the $250 one. You choose the amount, and you say, well, every single trade I will risk $250. And why do I say keep the risk the same on every single trade? Because if you don't, if you favor one particular instrument, you'll always lose on that one, and then you'll lose more money, and then it hash browns the whole thing. It messes it up. You need to keep the risk the same so that the losses remain the same. So every time you take a loss, you lose less than $250. You know, the reason I say less is because sometimes you'll get out of your losses early, just like you get out of your profits early. Well, kind of, you got to swap that mindset around, you see. Start getting out of your losses early and start holding your winners. Instead of holding your losses and dollar cost averaging and all that sort of stuff, and then finding out that you're going down into the doldrums, right? Something like that. Look after the wins, not the losses. Let the losses go. The most important thing is risk management. You've chosen your stop loss amount, and I just told you how you can take your trade. You just work out where the invalidation area is and you take your trade back up to the cost. Now all you have to do is manage that trade and be sure that it can actually make you more than $250, because why are you targeting a $50 profit if you're risking $250? That's just not on, is it? It's just not going to work, is it? You need to make more than $250 or at least $250 to be anywhere close to be either a break-even trader or a profitable trader. The whole point of this strategy is it breaks up the whole policy of the 50-50. Because if you're making more on the wins on the strategy and losing less on the losses, then it doesn't matter if the trade's 50-50. Did you know that the most profitable trading company on the street only won 20% of their trades back in the day? And you'll ask, how is that even possible? That's simple, because they made so much on their winners and they cut their losses short. They got out of their losses quickly. So the losing trades were not that big a deal. And the winning trades were the ones that they concentrated on winning with, adding to those trades, making them bigger, following them up. Those are the ones you want to look after. Those are the ones that are going to make you the money in the long run. And this is why people think they're hunting their stop losses out. Because what they don't understand is that the market is 50-50. Every single system in the market works. Doesn't matter what system you're using, what system you've got, every single system in the market works. First thing you have to understand is that trading is risky. Most traders lose money. If you don't like losing money and you don't like risk, you shouldn't be trading. Trading is inherently risky. While we're here, guys, don't forget to join the members area so that you can get a trade of the day every day and any other perks that come along with the members area. And also don't forget to subscribe while you're here. You know, that's cool. We like it when you subscribe. The whole point of this is to understand that the reason your stop losses are getting taken out is because you're working on a system that you learned on a course, and you expect that the squiggly lines are going to give you a win rate and they're going to make you money. Oh, that win rate. How many times have I said that a win rate can't make you money? What makes you money is a business plan and a strategy. A win rate, all it does is it gives you something to boast about, gives you something to run around and say, I got a win rate. If you win $10 on 8 trades, you win $80. And if you lose $100 on the 9th trade, I kind of, hang on. That puts you in a loss, but you've got an insane win rate. Go boast about it. Go talk about it. No, guys, the aha moment will come to you when you realize that it's not the win rate that's making money, that it's the strategy of making more on your wins that'll make you the dosh. Are they hunting out your stop losses? No. You're putting your stop loss there for them to find and take out and you're advertising it to them. And if you put it too close, they will take it because it's a whole bunch of liquidity waiting there to be taken. And the oaks will grab it because it's available. It's an order that's in the market. There's orders in the market. You'll see it ticking on the right-hand side of your charts. There's orders, buy and sell all the time. And they can see those orders. And the pros can see them a lot quicker than you and I can. I hope that helps you guys. I hope it answers your question. I don't know. You know, it's an open-ended question. I've been trying to answer that question for over 33 years. It's not something you just answer quickly. When you realize how irrelevant you are in that market, and you realize they're not hunting out your stop loss. They're looking for liquidity in the market that you've left there for somebody else to take. Because the market has opposing views. If the market didn't have opposing views, if people didn't buy and sell, the market would land on big zero and no one would make money. But we need to make money. The only way to do that is if we disagree. If the market is made up of human beings, not squiggly lines and algorithms. I just love it when I get comments about, oh no, the market, this mathematical equation and this and that. And I'm like, no, dude. People buy and sell from each other. They don't give it about the maths. Seriously, guys, forget about that. Thanks for watching the show. Don't forget to come back for the next one. If you need a funded account, drop down in the description. There is one there for you. Go and grab it. And on Thursdays, we have the 2-step 10K challenge giveaway, kindly sponsored by FundYourFX, which are in the link down below as well. Guys, thanks, cheers, ciao, and keep your feet on the ground, reach for the sky. Bye.